People keep asking the same thing. Why does the Japanese yen suddenly show up in the news every time markets get shaky? Today, I'll explain the simple engine behind that story. It's called the carry trade. I'll show you what it is, why it works in calm times, why it breaks in storms, and how that connects to liquidity, funding, and fast settlement. I'll also explain where something like XRP could fit in a real, practical way. No hype. Just mechanics you can understand. First, a quick note. This is not financial advice. Do your own research. Never risk money you cannot afford to lose. Let's start with the carry trade in one sentence. You borrow in a currency that is cheap, and you invest in something that pays more. The small difference between what you pay and what you earn is your profit. That difference is called the carry. Here's a simple picture. Imagine you can borrow yen at a very low interest rate. Then you buy a bond, a deposit, or some other asset that pays a higher rate. As long as the world is calm, you collect the difference. It looks easy. It often works for months or years. So, why the yen? For a long time, interest rates in Japan were very low. Big funds and banks could borrow yen cheaply. Then they spread that money into many places. Government bonds in other countries, corporate bonds, emerging market debt, and sometimes riskier assets too. Over time, this stopped being a few simple trades and turned into a big web of positions. It became a global habit. That habit is the carry trade. This system is quiet when markets are calm. When volatility is low, small moves in the funding currency do not hurt much. The machine keeps running. But when stress shows up, the picture changes fast. There are two common ways the trouble begins. The first way is when the funding currency gets stronger. Imagine the yen suddenly rises in value. You borrowed yen before. To close your loan later, you must buy yen. If the yen is stronger, you need more of your other money to buy the same amount of yen. Your carry profit can vanish. You might even lose. The second way is when interest rates move up. If the cost of borrowing yen rises, your trade is no longer cheap. The gap between your borrowing cost and your investment return shrinks or flips. The carry is gone. The reward is not worth the risk anymore. In both cases, the reaction is the same. People close positions. They sell the assets they bought. They buy back the funding currency to repay the loan. Liquidity needs jump quickly. This creates a chain reaction. Let's walk through that chain reaction in slow motion. First comes selling. Investors sell bonds or other risk assets and raise cash. That selling can push prices down, which creates more pressure. Next comes currency stress. People need yen to close their loans, so demand for yen goes up. If leverage is involved, margin calls arrive. Lenders want more collateral. If liquidity is thin, good buyers step back and spreads widen. You can still trade, but it gets harder and more expensive. This begins in interest rate markets and foreign exchange. Then it spills into credit, stocks, and even crypto. Pressure in one part of the pipe spreads to the rest. This is why global institutions like the IMF and BIS warn that liquidity can disappear when you need it most. It is not a secret plan. It is how the machine behaves when stress enters the system. Now, let's connect this to payments. Most cross-border payments still use pre-funded accounts. That means a bank keeps money parked in another country before it sends a payment there. In calm times, this is slow and expensive, but it works. In stress, it can hurt. You might need cash here, today, but your money is parked there, waiting. The mismatch becomes painful. This is why real-time settlement and instant payment networks matter. Faster rails mean less idle cash, fewer errors, and lower costs. A richer message format also helps because every payment carries clear labels. Who is sending, why they are sending, and what to do if there's an error. Compliance and auditing get easier. In short, speed plus clarity builds resilience. Now, Where could XRP fit in this real-world picture? Not in a magical way, not as a switch, but in some payment corridors. If using XRP reduces total cost and increases speed, an institution might keep small working balances. This is not about hoarding coins for speculation. It is about using less locked cash and moving more volume with lower friction. The simple goal is better capital efficiency. Lock up less, do more. At the same time, institutions care about stability and rules. That is why some stablecoins or tokenized payment tools with clear reserves and regular reports could act as bridges in certain flows. When legal clarity and transparency exist, old money and new rails can work together more smoothly. Let's think about XRP liquidity like a lake with 3 layers. On the surface, there is the part that trades on exchanges. It is fast, and everyone sees it. In the middle, there are balances held for operations. These are not long-term. They support payments. At the bottom, there are reserves that rarely move. If the middle and bottom grow, but total supply does not grow much, then the surface becomes thinner. That means fewer coins are available for instant trading. When the surface is thin, small buys or sells can move the price more. Reactions get sharper. This can happen in stress because the need for operational balances goes up while new supply does not appear fast enough. How do you notice when the surface is thinning? Keep 3 simple questions in mind. Are exchange balances falling while institutional wallets grow? Are large off-exchange deals taking longer to complete? And are futures prices staying above spot for a while? If the answer is yes to most of these, surface liquidity may be tightening. When that happens, both up moves and down moves can become sharper. Let's return to the carry trade and the yen. The same logic applies again. When the funding currency strengthens or borrowing costs jump, positions close. Selling rises. Collateral needs rise. Spreads widen. Liquidity feels fragile. That is the moment when fast settlement starts to look less like nice to have and more like must have. Speed and clarity reduce friction exactly when the system needs it. What should a normal person watch each week to understand this without spending all day? You do not need a complex dashboard. Take 5 minutes. First, check if the funding currency, in this case the yen, is getting stronger quickly. Second, see if the difference in interest rates is shrinking fast. Third, look at basic volatility indexes. Are they rising? Fourth, listen for margin calls and widening spreads in the news or in reports. Fifth, in crypto, check if exchange reserves are falling while big wallets grow and whether futures are often above spot. If several of these are happening together, stress is building and liquidity is getting thin. There is also the background of payment networks. You can follow official updates about instant systems going live or linking across borders. You can notice when message standards move from testing to production. You do not need the details of every document. You just need to know if real systems are turning on and joining together. When they do, cash can move with less idle pre-funding. That makes the whole pipe more flexible. It helps to remember 2 simple paths. In a smooth path, upgrades go live as planned, instant networks connect step by step, and institutions slowly move away from pre-funding. In that case, something like XRP might see quiet, steady operational use in places where it makes sense, and prices may feel tighter but calm. In a stressful path, liquidity dries up, funding costs jump, and everyone rushes into faster, cheaper settlement. Demand for instant liquidity spikes, surface trading layers thin out, and price moves get sharper. None of this requires a special date or a secret announcement. It is not about a single coin being chosen in one big moment. It is about rails getting faster and clearer and about tools that reduce cost in real flows. When stress comes, the practical and cheap solution wins. That has always been true. Let's tie the ideas together one more time. The carry trade is simple. Borrow cheap, buy higher yield, earn the gap. It works in quiet weather. It breaks when the funding currency gets stronger or when borrowing costs rise. When it breaks, positions close. Selling spreads, currency demand shifts, margin calls arrive, spreads widen, liquidity feels thin. The problem starts in rates and FX, then flows into credit, stocks, and sometimes crypto. Meanwhile, old payment systems that rely on pre-funded cash feel slow and heavy. New instant systems and richer messaging reduce that weight. They help cash move when and where it is needed. In that setting, tools that enable quick settlement with less locked capital can be useful, including in some cases XRP or well-designed stable instruments with clear reserves. You do not have to predict prices to understand this. You only need to watch a few simple signs once a week and ask simple questions. Is the funding currency stronger? Are rate gaps closing? Is volatility rising? Are spreads wider? Are crypto exchange balances falling while big wallets grow? Are futures above spot more often than usual? If the answer is mostly yes, then you know the system is tight. In tight systems, fast and cheap settlement becomes a priority. That is where the plumbing upgrades matter most. If someone tells you a dramatic story about what will happen next month or on a specific date, keep your calm. Ask them what data they saw. Ask them what changed in funding, in volatility, in settlement. If they do not have a clear answer, it is just a story. Real changes leave simple footprints. Stronger funding currencies, tighter rate gaps, rising volatility, wider spreads, and clear upgrades in payment rails. Those are the clues that matter. So now you know why the yen keeps showing up in stressful times. It is the funding side of a global habit. When calm returns, the machine can start again. When storms come, the machine slows, and the need for speed and clarity becomes obvious. That is the link between carry trades, liquidity, and modern payment systems. It is not mysterious, and it is not magic. It is just how the pipes of money work. And that is the whole point of this talk. No tricks, no extra visuals, no noise, just a clear explanation of a quiet engine that moves the world when no one is looking.